Hi, good afternoon, ladies and gentlemen. I would just like to introduce our moderator for the legal panel, Samallie Kiyingi. Just to sort of thank you very much for coming through to all the panelists and Samallie for the legal discussion. Just a brief introduction of Samallie. Samallie comes from Australia and she's admitted in Wales, England, and Australia. She started a legal career off at a law firm called Blake Dawson, which has subsequently been taken over by Ashurst. In 2005, she relocated after she was recruited by the international law firm Clifford Chance, and she joined the Africa practice. Specifically, she focused on structured finance and derivative transactions. In 2009, Samallie was appointed as the global coordinator of the Clifford Chance Africa Group. She currently serves as a director at Deutsche Bank, and she heads up the global securitization advisory function. Thank you, Samallie. Floor over to you.
Thank you for that kind introduction. And just to clarify as well, spent a lot of time in Australia, which will explain the accent, but actually born in Uganda, so put that out there as well. Thank you for joining us for this panel, which we think will be quite an interesting discussion on some of the legal issues facing investors in Africa. As lawyers, we tend to think that the best risk mitigant when doing business anywhere is having an amazing legal team. And I think on this panel, we have quite a good dream team. And I will introduce them briefly, but then also allow them to introduce their practices. So we have Andrew Gamble, who is a partner at Hogan Lovells. We have Marc, who is a partner at McKenzie. And we have Bruce Embley, who is a partner at Freshfields. And so what I will do is ask the panel a few questions to set the scene, and then open the floor up for questions, and perhaps you might even get some free legal advice, who knows. So I guess my first question to all the panelists is, could you share with us a bit about yourself and your practice? And given there is such a diversity of legal systems in Africa, perhaps you could tell us about a deal in a particular jurisdiction and some of the issues that you came across. Andrew, if we could start with you.
Right, happy to do that. Just to say something about myself, I work on the finance side in Hogan Lovells. I got involved in African transactions at the back end of the 1980s when I was asked by one of my fellow partners whether I was doing anything at the weekend, and I said no, expecting an invitation possibly to a party. Instead, I ended up in a meeting room with an oil company and a couple of banks, and found myself on a plane down to Cameroon on Sunday evening. That was at a time, in fact, it was probably a couple of years, or a year before the World Cup, when Cameroon did particularly well. If you remember Miller, for example, as a football player in Cameroon. And I still have a copy of the Sun newspaper, which had on the entire front page a picture of Africa and an enormous big arrow pointing to Cameroon and saying, "This is where it is, folks." And I think that that's a good indication of the state of knowledge, not only within the readership of the Sun newspaper, but also probably the population at large as to what Africa comprised and what opportunities there were in Africa. But even then, there were people who considered Africa an area for great development. And indeed, even in 1988, 1989, people were telling me that this was Africa's decade. Well, I've been through the 1990s and the 2000 and the first decade of this century, and people were still saying that it was going to be Africa's decade, and it wasn't on those occasions. I think that we actually are in a situation where it quite possibly is going to be Africa's decade. And I think that's been reflected really in the nature of my practice in terms of what I've been doing in Africa. So if I go back to that first trip down to Douala, that was in respect of a transaction which was linked to the oil industry. and was designed to generate some kind of secured structure in order to complete the development of the airport, the new airport at Yaoundé, because at that time the only international airport was in Douala. At the same time, I was working on transactions in Angola, because the whole thing rather snowballed, because they'd found someone who was prepared to get on a plane and go to Africa, which in itself was pretty rare. So I got involved in a transaction in Angola. And that transaction was for the grand sum of $60 million. It was a loan to Sonangol. Sonangol these days can raise loans of several billion. And that shows how that particular company and that particular country has progressed. Indeed, it wasn't so long ago that another aspect of my Africa practice, which is advising governments in terms of buying back old debt, I was acting for, on this particular occasion, for Mozambique. This was not so long ago. This was 2005. We bought back this old debt with the benefit of some soft loans from the World Bank. And we paid 8 cents in the dollar on principal only and gave no consideration to interest. If you went out into the market now and tried to buy back Mozambican debt at 8 cents in the dollar principal only, you'd be left out of court. So within a very short period of time, one's seen a dramatic change in terms of the landscape, both political and economic in Africa. And as I say, that's really reflected in the type of work that I've been doing. So it's migrated from doing oil-related transactions in places like Cameroon and Angola, through government advisory work where I was advising governments in terms of retiring old debt, to a situation where not so long ago I was working with governments like the Ghanaian government, who were issuing local currency bonds which were index linked. So suddenly you now find that not only are you coming up with more sophisticated products for governments, that it's an issuance of new debt, not retiring old debt, but also it's in a local currency, and that there is an appetite for financing in that local currency. Also, in terms of the industries that I've been involved in, originally it was oil, or it was mining. In, for example, in Zambia, we did a huge number of loans for what was then ZCCM. Now the work is very much orientated towards what I call the sort of second phase or second wave of business in Africa, and some of the earlier speakers and panels have been alluding to that. That in fact, one of the big areas of growth, of course, is stuff that actually indigenous Africans want, rather than foreigners who want to take their commodities want. So a transaction I'm working on at the moment is a transaction whereby we're building a factory to generate medical equipment, which is going to be used internally, and also, when capacity reaches a certain level, exported to neighboring African countries. So that's an indication of the change in the type of work that one's doing, which reflects a number of the trends that one sees in Africa at the moment. I think I'll probably end there, and I'll talk about a particular transaction later. But
that's fine. Thank you for that, Andrew. Very insightful. Marc, some of the legal issues you've come across, and a bit about you.
Yes, I'm Marc, partner at Baker McKenzie. I think I cover energy and infrastructure transactions, and I'm probably in the right place at the right time with Africa. And I think I echo what Andrew is saying, that you've seen a shift now from primary resource extractive transactions, which obviously remain a huge part of the growth story, to a lot of more secondary infrastructure that helps develop the country as a whole. I'll focus on one thing specifically, renewable energy, where you might think renewable energy is something for rich countries who are worried about the environment, and it's not for countries which are looking just to put power in place. But in fact, what we're seeing in large parts of Africa is a massive growth story in the renewable energy sector. It's being driven by Morocco and South Africa in particular, and South Africa at the moment has a tremendously successful program led by the government, and I think echoing some of the talks this morning, these are government-driven programs, but attracting private sector investment. And that's just closed a second round of projects across all types of renewable energy technology, with both foreign investors and South African investors. And to echo one of the points on how these things are funded, all of these projects have been, or nearly all of these projects have been funded by the South African bank market. And that's partly a question of one of the other points raised this morning, exchange rate risk and foreign lenders' concerns about the volatility of the rand, but it's also because there's enough money in the market for things to be funded domestically. On the Moroccan side, in North Africa, Morocco, again, tremendous shortage of power there, no natural resources, unlike some of its neighbors, and great, or no fossil fuel resources, I should say, but great renewable energy resources on the Atlantic coast and with nice sort of clean sunshine for solar power. And again, you've seen a number of projects so far funded by Moroccan banks. And again, working in Nigeria recently on more the telecom side, huge financing by Nigerian banks. So we're seeing a lot of projects in the infrastructure sector. It's not about foreign money coming in and building these things. It's about a certain degree of foreign expertise, developing infrastructure in these countries, but with local debt finance. I could talk a lot more about other things, but I think probably best to move on.
Thank you. And Bruce?
Yes, I'm an M&A lawyer, so quite a sort of disparate range of sectors that I've been working on in Africa. I first actually got involved in Africa through the transaction that Fatuma name-checked, which was the Investcom transaction that MTN did, which was actually not really an African milestone. It was the very first and still remains the only public takeover of a Dubai-listed company. But it was a really interesting transaction, and there were 6 African countries in its footprint, and 5 Middle Eastern countries as well. And I've had the privilege of working for MTN on a number of matters. So when you look at their footprint across much of Africa, that's given me a really good insight into a number of the key issues, and acting for them on a number of their subsequent M&A transactions as well. Been involved in other sectors as well, so ranging from acting for a bank on a hostile bid in sub-Saharan Africa, which fortunately we managed to swat away, to acting for Japanese trading houses on mineral transactions and oil and gas transactions. And I think probably the area that I'm seeing most focus on at the moment, I act for a number of our sovereign wealth fund clients, including a couple of the very active ones. And I think where a number of them see real potential in Africa is on the food security side. And the agricultural potential within Africa to not only feed itself but actually guarantee food for a number of these, certainly particularly the Middle Eastern sovereign wealth funds, where the food product they're most easily able to grow is dates, and after a while that you might looking to diversify a little bit away from that. So I think we will see a lot. There's already a lot happening there, but we'll see a lot more. And I mean, just to put it into context, somebody was telling me that Somalia is the 2nd biggest exporter of beef in the world, and even amongst all the troubles with the pirates, etc., every year 5 million cows still get transported. So I think we'll see a lot more on that side. And then the other area that people are starting to ask more and more is on the retail side. And I think that obviously ties into the middle class, but definitely a lot of our clients are now hovering around and trying to work out whether this is the time they need to start making their investments.
Could I ask a sort of question on that? Because it goes back to some of the comments, I think, in relation to the earlier panels, where about infrastructure. And in many ways, I don't think Africa is any different from many other emerging markets. So, for example, agriculture has been one of the issues, say, in the former Soviet Union. And one of the problems that they've had in terms of developing that sector has been infrastructure, even though they've had quite a high level of infrastructure from the old Soviet period. But I would have thought that that infrastructure is a problem for agriculture just as it is really for any other industry. I mean, I noted a story in the press quite recently about Mozambique where Rio Tinto had to, they'd marked down the value of their investment in Riverdale by $3 billion. And the reason they wrote it down is because, at least this is their press story, the reason they wrote it down was that they found they were not able to access the coal and ship that coal to ports to be able to get the value out of it. And Vale is confronting a similar situation in Mozambique and is basically having to put their own infrastructure in order to achieve that. And you know, I think there's still something of a disconnect, really, in terms of the need to get that infrastructure in before these other things can be developed. It's rather like a point was made by one of the speakers from MTN, where he was saying that basically all these boats need to rise on the same tide, because if you don't actually have those roads, you're not really, there's no point in developing the agriculture if in fact the fruit or the wheat is just going to rot, which has been one of the problems, for example, in relation to Russia. Well, it seemed to be better attended, so I thought I'd throw that in.
I mean, I think infrastructure clearly is a huge issue. The one thing I would just say is on the food security side, the really active players right now are the sovereign wealth funds, and they do have access to slightly more levers than your typical third party, and they're looking at it very, very strategically. So they are very, very not just the logistics side with the infrastructure and of course the raw food, but and they're very focused on that. But they're actually also thinking about the branding and those types of issues. So they have a pool of people who are focused on all that. That doesn't mean it necessarily their solutions, but they're going into it with eyes wide open.
Well, we've covered a diverse range of industries and also a number of different jurisdictions. And following on from that, and also listening to what was spoken about in the last panel, there was quite a bit of discussion about the importance of the regulatory framework and how it needs to be robust in order for people to invest in infrastructure long term and make that commitment. From your perspective, what are the emerging regulatory trends that you can see across the continent?
Do you want me to start?
You can start, yeah.
Gosh, what a topic. I mean, there's a just picking on a few of the key ones, and I'll talk about the perspective from the international investors coming in, because I think, and Patuma, I think, summed it up very well about how when you're an emerging market player within Africa, you have a slightly different approach to some of these issues. But I think the key regulatory issues, skimming through them very quickly, tax is number one. Tax predictability. There was a recent survey carried out amongst international investors, and tax was way ahead. And you only have to look. Somebody just changes the rules on tax, and your whole economic business plan just gets thrown out of kilter, and possibly worse.
How would an investor plan for that potentially?
Well, tax is, you can try and get your stabilisation agreements with the government, and that obviously depends on the right type of investment, and actually they are less predictable. They have some value, but maybe not as much as you might think. So I'll give you an example. I won't name check the country, but an African state up in North Africa, one of our clients had a stabilisation agreement where you basically agree over a period of time a predictable tax structure, and the government looked to change the rules midway through the investment, and they pulled out this document, and they said, well, actually that was only signed by the vice president, not the president, so it doesn't have effect. So even then you are slightly hostage to the fortune of the actual jurisdiction you're dealing with, which does make some people feel uncomfortable. The way most people now try and get around the issues like tax, but it goes much broader than tax, is through investment treaties. And you'll hear people sometimes referring to them as BITs or BITs, which are bilateral investment treaties, and which are generally treaties that heads of state or their secretary of states will negotiate with each other. They're very, very small documents, normally no longer than 8 pages long, incredibly broadly written, in the way that lawyers and all of our firms will have had a lot of fun playing around with them. And effectively what it does is it gives you access to an international arbitration dispute resolution mechanism to protect investments going into that jurisdiction. And so it will cover things like expropriation. And of course, tax is the thinking man's form of expropriation. There are blunter tools, and there are examples even within Africa. Guinea's seen a number, the DRC's seen a number of proper expropriation, but tax is the thinking man's expropriation. And these investment treaties do give you some protection. So we've acted for a number of clients where they've been treated unfairly on the tax or on the other things, even actually local court judgments that are deemed to be unfair vis-a-vis how they would treat other investors can be the subject itself of an investment treaty claim. And we've managed to secure an awful lot of money coming back to our clients who seek to rely on these, but actually their real use isn't at the sharp end where you're looking to enforce them, and actually there's a very high success rate of enforcing. In fact, there's even a secondary market for these treaties where, so for instance, somewhere like Argentina, which has the largest amount of outstanding treaty claims of anywhere in the world, you can sell those treaties, those awards, for about 20 cents in the dollar, because Argentina currently is one of the few places that isn't actually paying up on them. But most countries do pay up, and if you don't pay up, you effectively have your capital markets closed to you. So that's one way to deal with tax. Why don't I let these two...
I think one of the things you said that I think is really interesting in relation to the that stabilisation document that they sought to resile from. First of all, just before I make the comment, I mean, there is, I think, Heritage, arguing that they had a stabilisation agreement and that the Ugandan government have resiled from that. But as to the basis of that, I'm not familiar with the case, but that's clearly an example of the fact they had... No, I didn't know. But that was a case where there was an agreement arguably in place and it got revoked. But the fact that arguably the document itself wasn't properly signed. I mean, one of the things that I've found in all the time I've been working in Africa is that you actually do need to pay very close attention to the legalities. I mean, when I first started doing these deals in the 1980s, there was a tendency for people dealing with Africa to assume that actually there was no law they really needed to take account of, and that not a lot of focus was placed on, for example, the legal opinions from Angolan Council in respect of the early Sonangol deals. But the truth of the matter is there are legal systems, they've become much more sophisticated, and if in fact you don't pay due attention to what is required, including making sure that you have the right person signing the right piece of paper, you will get caught out. Yeah. You will get caught out. I mean, those days when one could be a sort of legal buccaneer have long since gone. I mean, you really do have to exercise proper due diligence and make sure you get really good local law advice.
To pick up on the tax trend, I think that there is a balance that governments are trying to find between attracting investment by offering tax breaks, which may have a limited shelf life, and then seeking to revoke those. And the need to bring in tax revenue as well and increase taxes. And I think certain resource companies probably benefited from a lot of attractive investment environments. And I think what you're seeing now is governments are just trying to normalize the situation and do what countries all over the world are doing and increase their tax base and raise revenues from companies and citizens. And companies are not happy about that. And so there's a lot of screaming, but it's really the way it's done has to be done in accordance with the rule of law in a transparent manner. You mustn't revoke agreements that have been passed you change things for the future. And I think it's where governments can get that balance right. And I think there are a few examples just been in the press over the past week with respect to windfall taxes on mining profits in a number of different countries and how those are treated. In South Africa, looking at imposing 50% taxes on mines. And that can completely destroy investor confidence. But if you do it properly, then it works.
And I think it is worth pointing out. I mean, people are very easy to point to Africa and say, "Oh, look at this." Don't forget, it's happening everywhere. North Sea oil tax was about as dramatic and as unpredictable. So it may happen a little bit more erratically in Africa, and but a lot of the techniques we will talk are actually commonplace wherever.
There's a windfall tax on the banks, wasn't there?
Yeah,
Absolutely.
exactly.
Here in the UK. And I think that is an important point, that Africa gets a lot of focus as a difficult market. But, I mean, I've worked in, as I mentioned, in FSU, and I can tell you, in terms of difficult markets, I mean, they have the potential to be much more difficult because on the whole, I think there is a recognition of the rule of law in most African jurisdictions in which I've worked. There is a sense that, for example, coming back to your example of the stabilization agreement, if the president had signed it, they would have probably stuck to that because that's authorized. In certain jurisdictions, and the Russian Federation is certainly one of them, you cannot rely on the fact that you did something right, you got it all properly signed. You can find that the government can override that tomorrow, and there's no recourse. There's no that they're going to shrug off any attempt to go against them under a BIT, and that is a sharp distinction. I mean, Africa gets a lot of bad press. I think as an emerging market, it's certainly no different. In many cases, a lot better as a place to operate in terms of legal certainty.
So I guess the myth or perception that's sometimes presented that it is harder legally to do deals in Africa is just that, a myth, in that it's no harder or easier than any other emerging market?
There are. I mean, Africa has unique challenges, and parts of Africa have their own unique challenges, as obviously everywhere does. I mean, just to elaborate a couple of those challenges. Exchange control can be much more aggressively policed in certain parts of Africa, and that can be incredibly difficult. And actually, the point that the economist from Citi made about currency issues. I mean, you will feel that in certain parts of Africa, maybe more than others. There are other issues. I mean, for instance, it seems to be a bit of an African phenomenon, but there's a lot more verbal agreements in parts of Africa than you might get in, and so when you're trying to do a transaction which is by its very nature very documentary, that can often conflict. And so I've had it in the odd place other than Africa, but by and large, most of my examples in Africa, actually, when you do an M&A transaction and somebody pops up and says, "By the way, well done on doing that. Did you not know I own 15% of it? Because I've got these verbal rights that somebody gave me, so I'll take my money now, please." You see a lot more of that in somewhere like Africa. And once you're attuned to it, you can try and navigate your way around it, but you have to be in tune with these types of issues. And I think the big one that obviously scares everyone to death on the outside world is bribery and corruption. Now, by no means does Africa have a copyright or a patent on bribery and corruption. There are many jurisdictions that would put most African states to shame. But it is, when you look at it, I think the reason why people focus on Africa so much is the Bonny Island is still by some way the DOJ in the US's largest ever fine. They have fined close to $1 billion for purely in relation to that one incident in Nigeria. And so that has formed a bit of a backdrop, rather unfairly, I think, in other parts of Africa. But anybody who tells you there isn't corruption in places like Nigeria is also smoking something. So that is an issue, and it is something something that I think a lot of our international clients can spend a disproportionate amount of time trying to work their way through.
And as a lawyer, how do you help them work their way through these, I guess, this terrain?
As a lawyer, you largely, I mean, and let's not forget also, just because something is regarded as corruption in one part of the world doesn't actually really mean it necessarily is. So, for instance, the DOJ only talks about bribing officials, whereas the UK decided to shoot itself in the foot and bring in this ridiculous bribery act a few years ago, where actually, technically speaking, if you go up to a concierge in a hotel and slip him a tenner and try and get, that is a form of that's an illegal act. So, and I suspect most of us in this room will have done something that, so you have to categorise these things, and you have to really know where your biggest exposure and risk is. And actually where most people are focused on is, what could the DOJ, what could the US do if they decide to come after me? Because what the US is doing is they're using their Foreign Corrupt Practices Act as a way to try and level the playing field, to give US companies more of a chance by going after international entities. And so there are various steps that you can do within that act. Particularly, it's all to do with step-in rights that give you, when you think there's and the types of training that you give, and the types of policies and procedures that you put in place, that all helps you mitigate. It can't stop the actual risk of somebody in a workforce of 20,000 doing something, but what it does do is it gives you a mitigation, and that's actually the sort of thing that companies tend to focus on much more. So at the legal end, yes, you can't do much to really alter the culture of a business. That's something that CEOs have to do and will often take generations to improve. But there are things that you can do that immediately, where the financial risk is greatest, give you forms of effective mitigation.
Okay.
But I wonder if that's a good example of how external legal regulation in the shape of the Bribery Act and the Foreign Corrupt Practices Act actually helps to improve business within the African continent, because it strangles off, so to speak, the source of the cash, so that basically when you're doing a transaction in a particular country, I mean, those business people in that country realise that what they may have done in the past, or may have asked for in the past, is not something that can be delivered on. So they actually have to, as it were, deal with the whole business issue in a different and more professional way.
Yeah, that's right.
Yeah.
And I think on the energy and infrastructure side, do you see any regulatory trends or moves by governments to, I guess, facilitate the investment that's needed for development?
There are quite a lot of common trends, and some may not be seen necessarily as facilitating, but which are, if you look at it as part of the Africa growth story, you have very much an idea of bringing in local content and creating jobs locally as part of a condition for investment for people who are attracted by the opportunities. So a very strong part of the South African energy program is about job creation, about skills transfer, and not just simple stuff like, oh, you must employ X% of South Africans, but if you are building a project in this locality, you must employ a certain number of people from the local village and create a certain number of jobs around. And I think it's probably a testament to the strength of the opportunities that this hasn't, to date, put people off. We're seeing the same in Morocco with its renewable energy program, where companies, if they want to come in and set up and build the wind farms that the government's looking to develop, they have to put factories in Morocco to build the components of those wind farms in Morocco. And you see that nature of policy where you're trying to create a much more integrated approach to infrastructure development quite across the continent.
Okay, thank you. I think I'll ask, well, did you want to say something?
Well, I was just picking up on the point about, we were talking about, you touched briefly on trademarks and intellectual property. I mean, it's quite interesting how that's become a matter of concern and interest and actually commercial exploitation. So You have the Ethiopian coffee growers who have managed to ensure that they've extracted value out of Starbucks and the like in terms of using the Ethiopian brand. And currently there are efforts by the Maasai to extract value in relation to the use of what they perceive as their intellectual property in terms of the Maasai name and the Maasai culture. And there are a number of cases going on in Africa like that at the moment, whereby not only is it a means of generating immediate cash in terms of saying, well, you've misused our intellectual property in the past, but also if you get the branding right, you can then license it and start using it for other indigenous businesses. So it's quite interesting to see that development.
Moving on from your point, and also the point you made about local content, I guess indigenization, those laws that are in various jurisdictions that seem to be emerging or in existence, how have you seen that affect investment or your clients in terms of where they're thinking of investing on the continent?
Well, I guess the most recent and highest profile relates to Zimbabwe, and it's not as if there's too much investment to frighten away at the moment, because there are lots of other reasons why people aren't going to Zimbabwe. I think that it's clearly something that businesses feel uncomfortable about, and probably more uncomfortable than local content, because in relation to indigenization, effectively ownership of the business that you're running is, or the majority of it's taken away from you. Whereas you can still own your business, but ensure other businesses work on your project under local content rules. And certainly I would have thought most governments should really focus on enforcing the local content rather than getting dragged too much into the whole area of indigenization. I mean, clearly there are some countries, and South Africa's one, where there are structural issues that need to be addressed over the long term. But outside of those sort of countries with a large, what one might describe as colonial population, there doesn't seem to be too much scope or need for it, I would have thought. And local content is what's going to be the main focus.
When you're seeing some interesting trends, actually, for example, in Kenya at the moment there's a 35% equity requirement, but the government's probably thinking of changing that just to 10%, effectively free carry on foreign investment into the country, where they'll just hold 10%, but they won't require to have a certain number of local shareholders. A government holding company could be set up just to own a percentage of foreign investment. But I think it's where it's done intelligently, where precisely you're looking at creating value and transferring skills rather than just having something for a political statement. But it's also it's not necessarily an obstacle if you have the other right conditions for growth. In the Middle East, in a number of countries, there's a 51% local shareholding requirement in companies, and that hasn't stopped in investment.
Although by and large, those local ownership requirements do result in incredible inefficiencies, and it's a real noose around businesses' necks. And the Middle East is a slow learner on that front, but actually I think thankfully many African jurisdictions are either pulling away from that or haven't gone into there, because there is always a way. I mean, we always tell all of our international clients when they're going into an emerging market, it's a temporary investment. You will either do so well there that at some stage the economics will have to be recalibrated, or you will find it too difficult. But either way, you're not going to be able to just have this phenomenal growth that's unchecked. There's always a way to be able to funnel some of the economic gains of a well-run business back into the economy. The problem is you don't want to choke it before it gets started, and that's what I think a lot of those types of policies do. I think actually where South Africa is with its BE schemes is actually it's around the right sort of level, because it is sort of still effectively a voluntary regime. I mean, you can't do effective business with government unless you have a good BE scheme in place. But it is I think it's been drip-fed into the market quite well. There's a little bit of flexibility around the types of tools you can use, so businesses can be a little bit more flexible, but ultimately there is also a realignment of the local and the international, or expectations and sharing of the wealth of those businesses.
I mean, the BE scheme in South Africa is enormously sophisticated. The way, in fact, the points that you get depends on a whole sequence of connections through the supply chain. So it gives you that flexibility, but also it has a cascading effect into the rest of the economy in terms of bringing in black empowerment, you know, at lots of different levels. But I think that coming back to your point about saying to people, look, you know, don't expect that you're going to be on this never-ending profit curve, you know, is a good point. And it's not, again, a unique African point, you know, just emphasizing the fact that, I mean, BP TNK, I mean, that is a sort of classic example. BP made a lot of money out of that joint venture. Eventually, the joint venture partners and the Russian state decided that was enough, and they changed the rules on them. So, you know, it's not, this happens in other emerging markets. Yeah.
Well, on that basis, I might open the floor up to questions. And see, there's a question down here. I don't know where the microphone is.
And when's lunch is a valid question.
And when is lunch is soon after this.
My name's Adam Green, I'm a reporter. Is that working? I'm a reporter with This Is Africa.
We can hear you.
Yeah.
There are two things that we've been looking at a bit recently, and I wondered if any of the panel had any comments on either of them. One is capital gains tax, and governments looking at capital gains tax as a way of helping them in their budgets. And the second is I wondered if any of you guys were looking at Guinea and what's going on in Guinea with regards to the mining reforms, and particularly these issues around Rio Tinto and the infrastructure on the Simandou, which is kind of some of the similar problems with Mozambique in terms of underestimating what their requirements would be in the infrastructure around their investments.
Did you want to start with
make some comments on the capital gains point? I mean, the sort of steps that are being taken in relation to capital gains, I think, are perfectly understandable. I mean, what effectively was happening was that ownership in very, very substantial assets, and I mentioned the Riverdale asset in Mozambique, that was effectively transferred to Rio Tinto for no capital gain tax liability at all, because of what the ownership was all held through offshore companies, and you simply buy the shares in the offshore company, albeit you've changed the economic ownership of the unit, and logic and fairness would dictate that some payment should be made to the government in relation to that. I think that I think there's a broader issue in relation to tax that, and I think a lot of African governments are still grappling with that. I mean, there was an article in the FT only this week in terms of Tanzania, and how if you look at the amount of capital allowances and the tax that the Tanzanians feel that they lose in comparison with the amount of investment that's coming in, they feel the balance has got out of sync. But there definitely is value in terms of those tax breaks. I mean, coming back to Mozambique, there's a lot of criticism of the Mozal projects. I mean, I worked on Mozal 1 and 2. I mean, at the time Mozal got put in, no one was touching Mozambique. The only way that was going to work, and a lot of the contribution actually came from aid agencies or multilaterals, was because of the tax breaks. I mean, I think that the point is that when these things are done, it goes back to your point, you need to put a finite limit on it, because looking at Mozal now and saying, well, they're only paying a 1% turnover. You know, they've changed the corporate rate in Mozambique now, it's 32%. But they're only paying sales tax, and that's 1% on Mozal. And clearly, you know, given the time that's elapsed, the return on the investment has clearly been achieved. And that I'm sure that African governments and African businesses are much more sophisticated now about working out life, as it were, for the tax concession and bringing it to bring it to an end.
I mean, on the tax, this is not an African issue. This is a global thing, and effectively, it's a reaction. I mean, the most high-profile one is obviously within India and the Vodafone SR transaction, but this is really governments trying to stop. Well, advisors, many are sitting on this panel, engineering structures to be tax neutral. And by now, many of them are now following the Indian example, and many states in Africa are doing the same, where they effectively follow the actual asset rather than looking otherwise, and that gives them a much easier way to track these things. I think there is a new normal where people, investors now expect this. I mean, there is a little bit of unpredictability. So, for instance, there was a bid for Cove last year when suddenly this CGT tax was introduced almost on the back of the offers, and that did actually force a couple of the bidders to go away because again it altered their economics. But I think that is starting to come through the wash, and now it is really a question of you largely expect there will be some form of tax, and who shares the burden. And actually, there was the Heritage example. Tullow successfully actually won their case. It was announced earlier on in the week, and this is all to do with a Ugandan transaction between Heritage and Tullow actually put the risk back onto Heritage, and Heritage has been saying that they shouldn't be liable, and the court came out and said they were. So I think by and large buyers and sellers are now much more savvy, but there is still an element of unpredictability. So I'll give you an example. It's an Indian one rather than an African one, but after the takeover of Cadbury's, which most people in this room, I suspect, wouldn't regard as an Indian transaction, the Indian courts are still out there trying to get a slice because they said Cadbury's had a part of their business in India, and so they want part of the change of control capital gains from Kraft arising from that. And I think if we see African states trying to be as aggressive as that, which is clearly at one end, and we've done an analysis on all risks around about 80 different countries and various categories, and tax nowhere is as far out of the field as India is. But if some of the African states, and Algeria for instance is close to that level of aggression, if we see many starting to push those, then that will just unsettle foreign investment, and it will go elsewhere where it is there's greater stability.
I mean, I think the whole tax thing is really interesting because one of the problems that African governments have got is collecting tax. And that because they have issues in terms of collecting tax, they then tend to latch on to things where they think they can grab the money. And that introduces a distortion, I think, into economic development. So one of the a story I heard in relation to the governor of Lagos State, who's very sort of conscious of all of this and has been doing a great job within Lagos State to take that state forward. He apparently requires anyone who wants a meeting with him to come up with their tax return. You will not get a meeting with the governor of Lagos State unless you show that you have completed your most recent tax return and paid your tax. And that, that sends out a message, because that is one of the problems. If in fact the recovery system was more effective, then it would involve some of the distortions which have crept in, and stamp duty is one. I mean, it's a sort of slightly arcane legal point, but stamp duty in Nigeria, by way of example, and also the company registration charge, these are big percentages. You're looking at something which combined is going to add another 2.5% probably onto a transaction, which can actually kill a transaction. And if you've improved recovery elsewhere, so you've got the revenue coming in legitimately in relation to active businesses, then you can scrap all these other taxes, which actually are slowing down business development.
The second half of your question, did you have any comments about Guinea?
I wouldn't go comment on Guinea specifically.
Okay, just so we could handle that. Does that cover your question? Yeah? Fantastic. Any other questions? There's a question at the back there, that lady in the...
like in a ping-pong game with the international oil companies, but the government trying to
We can hear you fine.
We can hear you, yeah.
With the government trying to make changes to the fiscal regimes in the petroleum industry, and the international oil companies kind of pushing back because they believe it will have far-reaching consequences on their investments. So does anyone in the panel have any comment to say about this? Or is there anything you think the government could have done better or should be doing to be able to make these changes? Thank you.
This is in relation to the petroleum revenue bill, is it?
Yes.
Yeah. I mean,
Marc?
do you want to?
I think it just goes back to the predictability point and the fact that the oil company is obviously the most obvious target to get money from. If you can put in place a sustainable, what government should be doing is putting in place a sustainable policy to raise revenue from a much broader base. And companies should also have a more realistic expectation that they're not going to benefit from what are perceived to be unreasonable exemptions and benefits in the tax system. So it's finding that balance, I think, if you're looking at what should be done on a longer term basis.
And going back to some of the things we said earlier, I mean, these tax concessions have had a beneficial impact as well in terms of ensuring that certain investments were made and certain industries built up. And I know from personal experience about a situation in Nigeria where the government's reluctance to do something in that space has meant that things weren't developed as quickly as they could have been. I mean, there was a big problem, I guess still a problem, in terms of gas flaring. And the oil companies were approached at one stage with a view to putting in a lot of investment so that the gas was then used in an IPP in projects, so gas-fired power stations. You know, going back to the comment about the outages in Nigeria and the problems that all causes. That never really got off the ground because the problem was that the government wanted the oil companies to make a huge amount of investment in terms of taking this gas and then using it in an IPP. But what they weren't prepared to do was allow the cost of doing that to be offset against the oil revenues. They basically split the, in fact, the law created a split between the profits generated within the oil sector and anything you did in other areas. And you weren't able to take losses or costs in relation to what was going to be the construction for the IPP, gas-fired power projects, and set them off against the revenues you were making on the oil side. So that never got off the ground, with the result it never really happened.
And I look at what's happening in Nigeria. I do a lot of work with various sovereign wealth funds, and I compare and contrast with what Nigeria has managed to do versus what certain other jurisdictions. So compare and contrast, say, Nigeria of Norway. Both very, very important oil producers, and you look at what Norway has been able to do in terms of channeling all of its profits without too much leakage at various levels, and how that has been able to fund the most incredible infrastructure, almost to the point actually there's nothing else to invest in Norway, and it's busy using it as a platform for elsewhere. And then you look at Nigeria, and it just feels to me, I know they're starting to get their act a little bit more and starting to think strategically, but if that sort of same mindset had been introduced 10 years ago, think about what could have been achieved, and it's quite sad in a way.
It's a bit of an unfair.
It looks like we're running out of time.
That's a slightly unfair comparison because Norway's a small, ethnically united country. You know, Nigeria's what, 160 million people, and must be what, 20 different linguistic groups. I mean,
there's been a lot of leakage of value in Nigeria.
Yeah, that's right.
Should have gone elsewhere.
Well, I'd like to thank the panel and probably close the questions for now and hand the floor back to Hein.